Welcome back to The Explainer. So, you know that feeling when you pull up a company's financial statements and it just looks like this impenetrable, boring wall of numbers? Well, we are going to completely flip that perspective today. We're decoding the corporate balance sheet. And I'm going to show you how this thing isn't just a spreadsheet. It's actually a dynamic, living blueprint of a company's financial survival. Seriously, by the time we wrap up, you'll be reading these numbers like a story. A story that tells you exactly how healthy or, how totally vulnerable a business really is.
Okay, let's dive right into this. Here is our roadmap for today. We're kicking off with the ultimate financial snapshot. Then we'll break down assets, basically what the company owns, followed by liabilities, what they owe. After that, we'll unpack equity using a real-world example. And finally, we'll wrap up with why this statement actually matters.
All right, part one, the ultimate financial snapshot.
To really grasp the balance sheet, you kind of have to change how you think about time in business. We aren't looking at some continuous movie of the company's entire year. No, we're looking at a highly specific photograph. The balance sheet gives you a snapshot of a company's financial position at one exact moment in time. This is a super vital distinction. Unlike your income statement that shows what happened over an entire 12 months, the balance sheet is just the exact state of affairs on the very last day of a month, or a quarter, or a year. It's this perfectly frozen moment capturing everything the entity owns, everything it owes to other people, and exactly what's left over for the owners at that precise second.
Now, I need you to burn this core equation into your mind. Assets equal liabilities plus owner's equity. This is the foundation of the entire statement. And here's the absolute crucial point. It must always balance. Every single dollar a company has, its assets, right, had to come from somewhere. It was funded by either borrowing money, which are your liabilities, or by the owners putting your own cash in, the equity. Literally, if this equation doesn't balance out perfectly, somebody did the math wrong. It's that simple.
Moving right along to part two, assets, or what the company actually owns.
Let's see how this builds out, the first real anatomical part of our blueprint, the assets. This is the fun part, right? This is all the stuff the company actually owns, the resources holding real economic value that help generate revenue. But we don't just toss all these assets into one giant pile. The crucial dividing line here is time. On one side, we have current assets. These are your highly liquid resources that the company expects to flip into cash within one single year. On the flip side, we have fixed or non-current assets. These are the heavy hitters, the resources used for more than a year. It's just a super practical way to see what money is available right now versus what's tied up playing the long game.
Let's do some rapid-fire examples of those current assets. First up, cash and cash equivalents. This is literally just the money sitting in checking accounts right now. Then you've got accounts receivable, so the cash your customers still owe you for stuff they already bought. Next is inventory. This is the actual physical stuff sitting in a warehouse, whether it's raw materials or finished products just waiting to sell. And finally, prepaid expenses. Think of this like paying your rent or insurance in advance. It's still value you own because you already paid for a service you're going to get in the very near future.
Contrasting with that, we've got the fixed assets. Like I said, this is the long game. The big one you'll always see here is property, plant, and equipment, or PP&E. We're talking the physical buildings, the heavy machinery, the land. Then you have intangible assets. They aren't physical, sure, but they hold massive value. Think patents, trademarks, brand reputation. You'll also see long-term investments in here, like stocks or real estate they plan to hold for years. And lastly, a specific one called goodwill. This represents the premium a company pays when they acquire another business for more than its net asset value. Bottom line, these fixed items are the anchor sustaining a business for years to come.
All right, part three, liabilities, or what the company owes.
So we've seen what they own, now let's pivot and look at the other side of our core equation, liabilities. This is definitely the less glamorous but incredibly critical side of the ledger, detailing all those financial obligations and future debts. Now, what's really interesting about this is how the liabilities perfectly mirror the timeline split we literally just talked about with assets. Just like assets, liabilities are neatly divided by that 12-month horizon. We've got current liabilities, debts due within a single year, and long-term liabilities, debts extending beyond that one-year mark. It is this brilliant symmetry. It lets analysts easily see if a company actually has enough short-term assets to cover its short-term debts.
Let's break down those current liabilities. These are the immediate pressing bills that are keeping the lights on right now. You've got accounts payable, that's the money owed to suppliers for goods you just bought. You have short-term loans needing a quick payoff. Then there are accrued expenses. These are costs the company has racked up but hasn't paid yet, like employee salaries or utility bills.
And of course, taxes payable to the government. Listen, if a business doesn't have enough current cash to cover these immediate pressing liabilities, they are in immediate trouble.
Then we have the long-term liabilities. These are the massive, slow-moving obligations extending far beyond that 12-month window. Companies usually take these on to fund major projects. Good examples include huge bank loans and bonds payable. You might also spot deferred taxes or long-term lease obligations, like renting a massive corporate headquarters for a 10-year stretch. You'll also find pension liabilities here, representing future retirement benefits promised to employees. Basically, these are the debts casting a very long shadow into the company's future.
Moving into part 4, equity and the Springfield example.
Okay, we know what the company owns and we know exactly what it owes. Now we transition to the final piece of our anatomical breakdown, equity, the grand finale of the equation. We're going to find out what is actually left over for the owners once every debt is subtracted from the resources. Owner's equity is the true net worth of the business. It is literally the leftover metric. If you liquidated every single asset today, paid off every single liability, this is what the owners get to walk away with. The components here include capital contributions, the money owners initially invested. Then retained earnings, which are just profits the company decided to reinvest into itself instead of paying out. And speaking of paying out, dividends paid show up here as a reduction, because handing earnings out to shareholders obviously lowers retained earnings. Finally, treasury stock, which accounts for any shares the company bought back from the open market.
Let's make this totally concrete with a simplified, real-world example from our sources. Looking at the balance sheet for Springfield Psychological Services for the year ending 2004, Springfield had total assets of $89,329. Their total liabilities sat at $61,540, and their owner's equity was $27,789. So, going back to our core equation, assets equal liabilities plus owner's equity, does the math actually work out?
And this brilliantly illustrates exactly how the equation works in practice. The total assets of $89,329 represent the entire pie. Then it's exactingly sliced up. $61,540 goes to what they owe in liabilities, and $27,789 is what they own in equity. $61,540 plus $27,789 equals exactly $89,329. The equation perfectly balances. Every single dollar of Springfield's assets is accounted for by either a debt or the owner's net worth.
Finally, part 5, why this statement matters.
So we've mastered the anatomy and the math, but look, nobody calculates these numbers just for the fun of it. This exact math applies to massive real-world decisions every single day. Let's walk step by step through who actually obsesses over this document. First up, investors. They use the balance sheet to assess financial stability. To an investor, a company with really strong assets and low debt is a vastly safer bet. Second, banks and lenders. They're checking this financial health before they ever even think about approving a loan. If they see high debt and low current assets, they might deny the loan outright or hit them with incredibly high interest rates. Third, business owners and managers use it internally to control expenses and shape strategy. If cash reserves are looking low, they know for sure they need to delay major expansions. And finally, governments and regulators review it for tax compliance and transparency, which is obviously super critical for publicly traded companies.
I want to leave you with one final, kind of provocative question. According to our core equation, equity is assets minus liabilities. So, if your liabilities exceed your assets today, what happens to your equity tomorrow? Well, your owner's equity drops below zero. It becomes negative. This is the literal mathematical definition of insolvency. When what you owe completely engulfs what you own, the business is on the brink of collapse. That is the extremely high stakes of financial health, and honestly, that's exactly why understanding the corporate balance sheet is the absolute ultimate key to reading the true story of any business. Thanks so much for joining me on this explainer, and I'll catch you next time.